If you own a mobile home park, well, it's not quite like owning other kinds of real estate. It's really an operating business, isn't it?
Oh, absolutely. You're managing a community, dealing with infrastructure, sometimes pretty old infrastructure, and let's be honest, often a lot of deferred maintenance.
Right. So when it comes time to sell, you can't just treat it like flipping a house.
Yeah.
Stick a sign out front. That's not going to cut it.
Not at all. The market for mobile home parks, or MHPs as we call them, it's very specific. And yeah, if you handle the sale like a single family home, you are almost guaranteed to leave, well, a lot of money on the table.
So our mission today for you listening is really to map out how to sell smartly. How do you get the best price without all the chaos?
Exactly. No panic selling, no leaving 50 grand behind just because you want to be done. We're going to look at the playbook from the practical prep work right through to some pretty advanced psychological strategies.
Okay, great. We've got a mix of sources here, brokerage reports, industry insights, even some behavioral finance stuff to give you the full picture. How to sell smart, part operations, part psychology.
That's the plan. We'll start with the science, getting the books right, fixing the asphalt. Then we'll pivot to the art, mastering the psychology behind things like seller carry financing. Let's dive in.
All right, part one, getting the mechanics right. When we look at park sales that kind of fall apart, where's the first mistake usually?
Almost always, it starts with neglect. Sellers sometimes act like buyers won't notice the obvious stuff.
Like they're wearing blindfolds, thinking a good cap rate hides cracked pavement or leaning utility poles.
Precisely. And that neglect, it's not just cosmetic. Buyers see it as immediate financial risk. Every pothole, every leak, every peeling sign that gets calculated as a capital expense they'll have to cover.
Okay, so step one is basic but critical. Get your park in order. And we're not talking fancy upgrades here, right?
No, not luxury renovations. It's about risk mitigation. You need to do a serious property assessment, walk every lot, fix the obvious leaks, patch the worst potholes.
And first impressions, curb appeal.
Huge. Mow the lawns, trim the trees, maybe a fresh coat of paint on that entrance sign. You want it to scream professional management, not, Dateline Disaster Park Edition.
I got it.
Yeah.
So fix the physical stuff. But you mentioned something else being even more powerful.
Yes, the financial prep. Cleaning up the books. This is where so many mom and pop sellers, frankly, just bleed value. Buyers hate mystery boxes. They need verifiable income.
What's the real difference in value between, say, messy spreadsheets and clean, organized financials?
Confidence. Pure and simple. Chaos kills confidence. If your rent rolls are a mess, expenses are all lumped together, tax returns don't quite match the P&Ls.
The buyer gets nervous.
Instantly. They add a risk premium. Clean books, though. They signal you're a pro. It makes their due diligence easier, builds trust, and often translates directly into a higher offer because they believe the net operating income figure.
Okay, so park looks decent, books are clean. Now step two, setting the right price. This seems like another minefield.
Oh, it is. We see it constantly. The owner who's run the park for 30 years thinks their special knowledge means it's worth 10% more than anything comparable.
The legend in your own mind trap, as you call it.
Exactly. Look, that character, or your sentimental attachment, it doesn't raise the net operating income. The market cares about comps, cap rates, occupancy, cold, hard facts.
But hold on, if I know I could raise rents tomorrow, shouldn't that count for something beyond a standard appraisal?
It counts, but only if it's objective and believable to a buyer who, let's face it, doesn't know you or trust you yet. You have to study comparable sales. Know the current market cap rates for your area, your type of park.
And the danger of getting it wrong.
It's twofold. Overprice and your listing just sits there getting stale. Buyers think, what's wrong with this place? Underprice, and, well, you'll be kicking yourself when the buyer drives off in their brand new truck paid for with your equity.
So the action item is clear.
Get a professional appraisal. Ground your price in reality. Don't gamble.
Makes perfect sense. Okay, on to step three. Marketing. That doesn't suck. Please, tell us people don't actually use blurry dumpster photos.
You'd be surprised. Or like an ancient Google satellite view from 10 years ago. It screams desperation or, worse, that you're hiding something.
So what's the pro strategy?
You're telling a story, remember? Not trying to catfish someone. Get professional photos done. Show off those newly paved roads, the clean signage, the layout. Sell the vision of a well-run, easy-to-manage community.
But where do you push this story out?
Use the major online platforms, absolutely. LoopNet, Crexi, Mobile Home Park Store. But don't underestimate professional networks. A good MHP broker often has buyers lined up.
It might find a buyer before it even hits the public market.
Happens all the time. Saves you time, hassle, maybe even gets a better price.
Okay, listing is live, looking good. Inquiries start coming in. Step 4, engaging smartly.
Speed is key here. You've got momentum. Don't lose it. Respond fast. Don't play hard to get or wait days to call back because you're busy fixing a sewer line. Every delay cools off a potential buyer.
And when you talk to them?
Know your numbers cold. Lot, rent, occupancy, expense ratios, cap rate. Sound like you're running a tight ship, not like you're desperately trying to escape one.
Project confidence and competence.
Exactly. And when offers start coming in, focus on the deal structure, not your ego. Seriously, don't kill a six-figure deal because you're arguing over a $600 repair credit out of pride. Keep your eye on the prize, a clean exit, maximum net proceeds.
Okay, this brings us to the really advanced stuff. Part 2, seller carry psychology. We've got the park looking good, priced right, marketed well. Now, how do we potentially unlock even more value, especially with maybe a hesitant mom-and-pop seller?
Right. This is where we move beyond the mechanics, beyond patching potholes and into, well, emotional calculus. We need to talk about convincing a seller, often a very conservative one, that seller financing becoming the bank isn't some risky gamble, but actually a brilliant strategy.
This sounds like it gets into behavioral finance territory.
It absolutely does. You know, a seller's retirement, their life's work, it's all tied up in this park. There's pride, legacy, and often a lot of fear. If fear is blocking logic, no fancy cap rate projection is going to convince them.
So you have to understand and address those fears directly.
Precisely. And the most powerful psychological tool we have here is something called loss aversion.
Loss aversion. Remind us.
Basically, people hate losing something they already have much more intensely than they enjoy gaining something new of equal value. The pain of loss is stronger than the pleasure of gain.
Okay, so how do you use that when talking about seller financing versus an all-cash sale?
You flip the script. You frame the all-cash sale as the real loss. Think about it. Sell for cash, and boom, Uncle Sam immediately takes 30%, maybe 40% of your gain in taxes, right off the top. That's a huge, immediate loss of capital you worked decades for.
Ah, I see. So the cash deal, which feels safe, is actually positioned as the guaranteed way to lose a big chunk of money up front.
Exactly. Then you present seller carry. With seller carry, that entire pre-tax amount keeps working for you. It's earning interest, often at a good rate, and the taxes are deferred over the life of the loan.
So the seemingly riskier option, seller carry, suddenly feels like the financially smarter, safer way to preserve capital.
That's the reframe. It combats that initial fear. And there's another layer, identity alignment.
Identity alignment, what's that?
For someone who's poured their life into building this community, selling can feel like losing a part of themselves. Seller carry offers a new, elevated identity. You ask them to graduate from landlord to banker.
I like that. Graduate from landlord to banker.
Yeah. You're done with the day-to-day headaches, the tenants, the toilets, but you maintain that steady monthly income, like a pension, and you gain the status of being a financier. It also activates the sense of stewardship.
How so?
Because with seller carry, you, the seller, get to vet and choose the buyer who takes over your park. You ensure it goes to someone who will, hopefully, carry on your legacy responsibly. You're not just cashing out and walking away blind.
That's powerful. It makes it less about just money and more about continuing something you built.
Precisely. It simplifies things, too. It's like a pension monthly checks, zero management. You replace the anxiety of managing a park with the comfort of reliable retirement income.
Okay, but the big objection always comes up, doesn't it? What if the buyer defaults? That must be the #1 fear.
It is. Absolutely the biggest hurdle, and you have to meet it head on. But again, it's about reframing. Default isn't just risk, it's potential leverage.
What do you mean?
The seller holds the note, the lien, the deed of trust. If the buyer defaults, which, by the way, is less common than people fear if the buyer is properly vetted what happens, the seller gets the park back.
Oh.
And not only do they get the park back, they get it back after the buyer has likely put in their own capital for improvements, and the seller keeps every single payment principal and interest made up to that point.
So worst case, you get your asset back, awfully in better shape, plus all the payments made so far.
Exactly. It's not disaster. It's almost like a backup form of ROI. The risk is significantly mitigated by the collateral you hold.
That's a strong counter. What about liquidity? Objection number 2. I might need a lump sum later. What if I need cash for an emergency? People think that note ties up their money.
Yeah, that's a common misconception, but a performing note secured by real estate, that's a liquid asset. It's not trapped.
You can sell the note.
Absolutely. There's a whole market for buying and selling performing notes. Or you could potentially borrow against it. It represents collateral and cash flow. It's arguably more dynamic and predictable than having cash sitting in a volatile stock market.
Good point. Okay, final classic objection. Look, I'm exhausted. Why not just take the cash and be done with it all?
We hear that a lot, but you have to challenge the premise. Is the all-cash sale really being done?
What do you mean?
Because taking that lump sum instantly creates two massive problems. One, a huge tax bill. Two, a brand new full-time job you didn't ask for.
What job is that?
The job of managing that lump sum. You now have potentially millions of dollars, and you have to figure out how to reinvest it safely, how to beat inflation, how to generate enough income to replace what the park provided, all while navigating market risks. That's stressful.
So the seller carry means you're done with the tenants and toilets, but not done with a reliable income.
Perfectly put. And you normalize it. Banks do this every single day. They lend money secured by assets. Seller financing just means the seller gets to play the role of the bank, earning the interest themselves.
This reframing is key. And you mentioned ethical FOMO, fear of missing out.
Yeah, subtly. You can share, maybe anecdotally, how some sellers who took cash later regretted missing out on years of steady, high-interest income and significant tax savings. It plants a seed.
And storytelling helps here too.
Immensely. Numbers can feel cold. Stories connect. You don't lecture them on capital gains tax brackets. Instead, you talk about Jane and Joe, folks like them who sold with owner financing 5 years ago. Now, every month, that check arrives, giving them peace of mind, funding their travels. Stories slip past skepticism where data might hit a wall.
It makes it relatable, tangible.
And finally, there's a bit of an ego stroke, positioned correctly. Seller carry isn't the desperate option, it's the sophisticated option. It's the seasoned way to exit. It aligns them with a smart group of insiders who understand tax efficiency and long-term wealth preservation.
So you're appealing to their intelligence and experience. You didn't just own a park, you built something. This structure honors that and secures your future.
That's the goal. It shifts the whole dynamic from a potentially panicked exit to a well-planned strategic transition. So wrapping this up, selling a specialized asset like a mobile home park, it really is deeply personal, isn't it? It's part science, getting the property and financials right, and it's part therapy, understanding and navigating the seller's mindset.
Right. The ultimate goal is to get what you truly deserve for the years, maybe decades, you put into building that community and that business.
You didn't endure all those late rent calls, the infrastructure headaches, the zoning battles, just to fumble the exit strategy.
So the core tenets we discussed: prepare meticulously, price it right based on data, market it like you mean it, and then engage buyers strategically, aiming for that potentially more lucrative deal structure like seller carry.
By mastering both the operational nuts and bolts and the seller psychology, you can navigate this complex sale effectively. You can get through it without losing your mind or, more importantly, leaving a chunk of your retirement on the table.
Okay, let's leave our listeners with something to really think about. Here's a final provocative thought. Never confuse a massive tax bill with a successful retirement plan.
Alignment over argument every single time.